implementation date. So they are listed by implementation date for this year, 2024. We do have just a small leftover from GASB 99. So GASB 99 actually was due to be implemented in 2022, 2023, and 2024. So most of it's already been implemented. It's just one remaining part of GASB 99 that I'm not going to discuss today because I think most of you will not have to deal with it. It has to do with derivative instruments, like swaps and those types of instruments. And before 99, all swap or all derivative instruments were either classified as investment derivatives or hedging derivatives. But GASB 99 is basically saying you can have other derivatives that don't meet either the hedging or the investment criteria. And it just provides guidance on how you should display those other types of derivatives. And it's pretty much the same way you would display investment derivatives. It's just different line items. I'm not going to spend any time on it because I don't really believe that is applicable to most of you. But just wanted to remind you that that's the last piece of GASB 99 that is due to be implemented in 2024. GASB 100 is really the one that you're dealing with this year. Accounting changes and error corrections. It's a fairly simple one. We will spend some good time talking about it, but it is not really that complicated. Next year, I know. 2025, we have compensated absences. So that I would say that is probably the one that have the most complexity, in my opinion. Like I think this is the one that most of you are going to spend most of the time trying to deal with it. And then GASB 102 is mostly a disclosure statement, certain disclosure risk disclosures. And then finally, GASB 103. Sorry, typo. Yeah, no, it's not the same. GASB 103 is the financial reporting model improvements. I don't know how we ended up having that. But financial reporting model improvements, that basically was intended to be a major standard. It was intended to be the new GASB 34. When you read through GASB and their basis for conclusion and so on, they always have an analysis of the cost benefit. And you can see that in their analysis, they basically said that most of the work that they've done on GASB 103, they realized that it was not cost beneficial. Even though we said in so many presentations and we listened to so many of the things they were planning on doing and short-term and near-term and governmental funds, and all of that got scrapped, which I guess is good for you, that now GASB 103 is really focusing on just improving the existing model with in few areas, specifically focusing on the MD&A. So we'll talk quite a bit about that and we'll give some examples about those. All right, so now let's talk about GASB 100, accounting changes and error corrections. And, GASB 100 is like I said, it basically is dealing with restatements. Anytime you're having to do a restatement or changing accounting principles, changing in estimates, correcting errors, how you should display those, how you should account for them. So we'll get started. The purpose of GASB 100 is establish reporting requirements for accounting changes. So changes in GAAP, changes in accounting principles, changes in accounting estimates, and also changes within the reporting entity. And we're going to talk in more detail what we mean by each of them. And then error correction. So those are the two main areas, accounting changes and error corrections. And accounting changes can be divided into changes in accounting principle, changing in estimates, and changing in the reporting entity itself. So we'll put all four side by side and talk about, compare them to each other and how they're treated. So let's talk first about definition of changes in accounting principles. So that basically is applying a different GAAP to existing transactions or implementing a new GAAP. So if you have a new statement like GASB 96 or GASB 87, that's a new GAAP. And you will need to comply with it. That is considered to be an accounting principle change. But also applying a different GAAP on something that you've already been accounting for. For example, Just basically, like how you used to account for your loans receivable, and now you're applying a different gap because you feel that it is better. And we're going to talk a lot about what do we mean we feel is better. Like you have to justify why that gap is better. So different gap is preferable than the old gap. So that you're always going to have to make that case. So you can't just change for the sake of changing. You have to explain why you believe the new gap will present better information than the old gap. So how do you assess that? Preferable based on those are the objectives that you're trying to accomplish anytime you're reporting financial information. Understandability, reliability, relevance, timeliness, consistency, and comparability. Those are the things that we are trying to accomplish in reporting financial information. So when you choose a new gap compared to an existing gap, you have to demonstrate that the new gap enable you to achieve those objectives better. All right, so that's for changes in accounting principles. You can also have changes in accounting estimates. And changing in accounting estimates normally happen either by having a change in the methodology of how you're calculating the estimates, or a change in the input itself, the factors that goes into calculating the estimate. Normally, a change in the input results from changes in circumstances, new information, more experience, and so on. So for example, if you're looking at your pension, the input are things like, okay, I can take that. Yeah, that would be great. All right, seems working. Thank you. All right, thank you very much. So normally when we talk about changes in input, it's the results of changes in circumstances. So for example, CalPERS may decide that, our discount rate is no longer a good input. It needs to change based on the circumstances, based on the facts that we know. However, a change in methodology is how you're actually coming up with the estimate, the calculation, the approach. That normally when there's a change there, you have to demonstrate that this change in methodology enable you to meet those objectives of having better understandability, reliability, comparability, all those elements that we are looking for. Then you have a change in the reporting entity. And actually, I am starting to see that this is probably going to be the most common that we see in most of our clients, or the changes in the reporting entity. Because something like this, for example, additional removal of funds resulting from movement of continuing operation. I honestly can think of several that already are dealing with this situation. I'm actually not sure if this was I feel like there's something in the audio, like, don't you hear something? Like I feel that there is a little bit of echo. Maybe I'm just the one hearing it. Sounds good to you? Okay, I guess it's
might be the change.
yeah, I guess it's coming in my ear. I'll just put up with it then, as long as everyone else is can hear fine. All right, thank you. All right. So for example, let's say you have something like a recreation fund, and that recreation fund is an enterprise fund. And then you realize, hey, this should not really be an enterprise fund. It's not covering its cost. We're going to move it back to the general fund. That would be a change in the reporting entity, because you're basically closing a fund of continuing operation. So it has to be, the operation has to be ongoing. And you decided, no, I'm going to take it out of the enterprise fund and put it into the general fund. That's a change in the reporting entity. However, if the operation is discontinued, that's a different story. So that can be subject to GASB 69, the disposal of government operation. But just the regular movement between funds of continuing operation, that will trigger a change in the reporting entity. a change in major or non-major funds. That will happen on a regular basis. You have a new fund that qualified to be a major fund that used to be non-major last year. That changes your reporting entity. So those will be common occurrence that we're going to see as a result of GASB 100. And in most of the cases, there are no changes in accounting. It's just really how you disclose them, with some exceptions that we're going to talk about. Addition or removal of component unit or change in presentation as blended or discrete. So you add a component unit, a housing authority or financing authority, a component unit that used to be discretely presented and now is blended because it does not meet the criteria to be discrete, or vice versa. So those would be also changes to the reporting entity. And then finally, error corrections. And I think error correction is very straightforward. Error corrections are the results of mathematical mistakes, mistakes in applying GAAP, oversight or misuse of facts as of the financial statements date. So what do we mean by facts as of the financial statement date? Those are facts that are reasonably expected to have been taken into account about conditions as of the financial statement. So it's a professional judgment, but it's what a reasonable person would have expected you to know as of the financial statement date, that those were things that you should have known. They were the facts were available. And then finally, a change from non-GAAP to a GAAP is an error correction. So not just because you used to account for something incorrectly and now you're following the right GAAP, that does not make it a change in accounting principles, because what you were using before was not even an accounting principle. So you wouldn't consider that a change in accounting principles. Change in accounting principle has to be from an approved GAAP to another approved GAAP. But when you were using your own basis of accounting, and then now you're following GAAP, that's an error correction. Okay. So this is a definition of what you can possibly have as a result of GASB 100. And remember, we're really looking to determine, what is the impact on beginning balance as a result of a change in accounting principle, a change in accounting estimate, a change in the reporting entity, and also error corrections. And then how do we display that in the financial statements? Like, what is the right way to display it? So those are the definitions. And now we can move on to the financial reporting. So for changes in accounting principle, you're always going to restate. So if you have a single year financial statements, most of you, like if you're a city or most of you have a single year financial statement. So all you're going to do is basically restating your beginning balance, your beginning equity balance, to reflect the changes in implementing the new GAAP or changing an existing GAAP. If you have comparative financial statements, so meaning you have 2 years next to each other, if you're a water district or a special district, then you have to restate the financials of both years. We're not saying restate the beginning equity, restate the actual financial statements. So if, let's say, for example, you were implementing OPEB for the first time, then last year numbers, you have to also put OPEB liability or deferred inflow, deferred outflow, not just the current year. You actually have to display these numbers on both years. And then the previous year, the last year, so if you have like 2024 and 2023, you're still going to show a restatement for 2023. So the beginning balance of 2023 will be restated to reflect what is the impact from prior. And then you will then show the 2023 column with the right numbers and the 2024 columns with the right number. So that's in a comparative financial statements. If you have a change in accounting estimates, that's easy because it is accounted for prospectively, okay? Meaning that no restatements are needed. You decided that your inputs need to be adjusted for your estimates, or that you decided that you're going to change the methodology of how you're calculating your estimates. That is prospectively. So for example, claims liability. If you decided that we're going to use a different methodology on how to estimate claims liability, you're not going to go back and restate. You're just going to record that effect during the current year that you make that change. Changes in the reporting entities. That's a tricky one, and that's the one that is more common. So adjustment to the current period beginning equity balances as if the change occurred at the beginning of the period. So that is really critical. So that same example we were using about closing down a recreation fund and rolling it back into the general fund. Let's say you made that decision on December 31st. So like 6 months into the year. Under existing standards, what you would do is basically you would just do transfer during that on December 31st, basically moving all the assets and liabilities from that fund into the general fund, and then continue accounting for the recreation activity in the general fund. So what you end up with is having the first 6 months of the year with revenues and expenses in the enterprise recreation fund. And then the last 6 months of the year, the revenues and expenses of the recreation are actually in the general fund. So now with GASB 100 is basically saying you can no longer use the transfer for that. You actually have to do a restatement with the assumption that that change happened on July 1st. So that way, so even if you decided to do it December 31st, you will actually have to restate the recreation fund beginning balance and the general fund beginning balance. And that way, 100% of the revenues and expenditures relating to that recreation fund is now in the general fund. So you assumed that that change happened on July 1st, regardless of whether you did it on July 1st or not. You may have done it June 29th. You were still going to consider that July 1st. So it's just something to keep in mind because you still have to move the revenues and expenses. So one client I was talking to said, well, I guess note to self is that we're only going to open and close new funds on July 1st. So we don't really have to move revenues and expenses around. Anyway, it's just something to keep in mind. I mean, of course, you cannot time it that every time you're just going to do it July 1st, but just keeping that in mind that you have to move all the activities as if it happened on the first day of the year. And then finally, for error corrections, for single period financial statements retroactively by restating the beginning equity balance. So for most of you, you find an error in last year, you restate the beginning balance of last year. Or the beginning balance for 2024, which will be the ending balance for last year. Yes, sir. They did tell me not to go next to the speaker, so I'm going to have to go this way.
Adjustment, where you're bringing one of the funds into the general fund. Okay. So you're restating those balances as they would have occurred on the beginning of the fiscal year. Okay, that's fine part. Okay. But the question that I have in my mind is if you're doing a comparative financial statements for 2 years and you're doing a budget to action, okay, as part of that comparison, what do you do with the budget number for that? What do you do with the budget amounts that were adopted by the governing body where they adjusted the budget for just 6 months, but you're showing the actual revenue and expense for the entire year? You're going to get some weird numbers coming.
Well, there's usually no budget to actual comparison for prior year numbers. No, there is not. Usually comparative report would be comparative on the government-wide, the fund financials. But honestly, most comparative reports we see are on single, like special purpose government, like a water district. So they only have the balance sheet and income statement. For a city, for example, where the budget to actual comparison are required, even in a comparative report, the budget to actual would be just for the current year.
My second question is, in the statistical section, where you're going back 10 years,
that will, yeah, that will be covered. I'm probably going to just stay on this side to make sure I don't get close to the speaker. All right, so for comparative financials, you're going to retroactively restate basically all periods presented. And restating all periods presented, meaning like you're changing all the balance sheet and income statement numbers to reflect what the correct numbers would have been. And then you're also gonna restate the beginning balance of the first period presented, because that's the opening balance. So that's for the accounting and financial reporting for those. As far as disclosure, changes in accounting principles, you have to disclose the nature of the change, financial line items affected. So normally, if you're implementing GASB 87, for example, you're going to say that your capital assets for intangible assets are impacted, your long-term liabilities for any leases liability are impacted, your deferred amounts are impacted for leases receivable. So you have to state what line items are being impacted by that restatement. Obviously, if it's a new GASB being implemented, you have to identify which GASB. You also, except for any new GASB being implemented, you have to specify the reason for the change. Obviously, if it's a new GASB, you're required to implement it, so you don't have to specify any reason. But if you're changing a GASB just because you feel it will provide you better measurement, you have to really explain why do you think is preferable. And you have to also state what is the effect on the beginning balances, the equity balances. As for accounting estimates, again, nature of change, financial line items that are being impacted, only a change in methodology, except required by GASB, you have to specify the reason why you're changing the methodology, why this makes the numbers more understandable, reliable, timely, and so on. If there's a change in methodology because that's what GASB is prescribing, then obviously you don't have to specify why you're making the change. As for changes to the reporting entity, again, always you're going to have to explain the nature of the change, the reason for the change. If the change is just a matter of you have one fund that didn't meet the criteria to be major last year and this year did meet the criteria, that you don't have to explain. If it's strictly the results of just meeting the criteria of major fund or non-major fund, that 10% and 5% test, that you don't have to explain. But if you're choosing to make a fund major, even though it doesn't meet the criteria, you need to explain that. And then effect on beginning equity balances. Finally, the error corrections. The nature of the error and correction, financial statement line items impacted, the periods affected. For single period financials, effect on prior period change in equity had the error not occurred. And for comparative financials, effect on the change in equity of the prior period, and also effect on the beginning equity balances. So really the restatement note is now going to be two components where you can have a narrative component explaining, what is the change, what is the nature of the change, what are the line items impacted, and then there is a component stating the numbers, the effect on the equity, and so on. I'm going to show you an example, but before I do that, I want to talk about the adjustments that actually does not change fund balance. So sometimes you can have restatements, but the fund balance didn't change. So for example, most of you, when you implemented GASB 87 and GASB 96, there was really no impact on the beginning equity because you added assets and equal liability amounts, the intangible asset and the lease liability, or the beta asset and this beta liability. And at the beginning of the period, they equaled for the most part. I would say 99% of you. So even though it's a restatement, there was no impact on the financial statement, on the beginning equity. So the rules are, it's still a restatement. You still have to provide all the disclosures that are needed, not just because it has a zero impact on fund balance or on equity. That does not mean it is not subject to GASB 100. So saying a change in GAAP or error correction that does not have an effect on beginning equity balance, but that results in classifications in the financial statements requires the same disclosure as you previously discussed. And then aggregate amounts of adjustments to and the restatements of beginning equity should be displayed for each reporting unit. And I'm going to show you how it looks like. But basically, you need a total at the end saying, well, these are the total amounts of adjustments that we're doing for each reporting unit. So talking about required supplementary information, statistical section, supplementary information, when do you have to go back and actually adjust those? So in situation where you have a change in accounting principle or a change in the financial reporting entity, you really only have to go and for the RSI, the required supplementary information would be like your budget information, your pension information, your MD&A. Supplementary information would be all your non-major funds and so on. So for those, for the reporting periods should be adjusted or restated in the same manner as the basic financial statement. So if you have RSI that shows 10 years and you're reporting on fiscal year 2024, you really only have to adjust the RSI column for 2024. You don't have to go back and adjust any periods that are not presented in the financial statements. Obviously, if you have a comparative financial statements, then you have 2 years to adjust. But that's only for accounting principles and changes in the reporting entity. Okay. RSI and SI for reporting periods not presented in the financial statements should not be adjusted or restated. For error correction, on the other hand, RSI and SI for the reporting periods will be adjusted or restated, same as the financial statements. For the periods not presented, should also be adjusted or restated. Mitesh, I think you clicked out of this.
Realize when I switch the reshare the screen again.
Okay. So maybe hands-free from
Yeah.
Okay. Okay. All right. So for error correction, what we're basically saying here, I'm sorry, Mitesh, you need to click on it. Okay. Sorry. So for error correction, what we're basically saying is that because it's an error, you actually have to go back and adjust everything. If you have 10 years of statistical data, you need to go back and adjust all 10 years. You need to also label them as corrected or restated. If you cannot restate them, you need to say why you cannot restate them. But if you discover that, oh, we haven't been recording, we've been accruing revenues incorrectly for the last 15 years, you're going to have to go and adjust the 10 years in the statistical section, or if it's in the required supplementary information, to reflect what the correct numbers are or should have been. If it's not practical for you to do that, you will have to explain why it's not practical to do that. Okay. So error corrections is treated differently. You have to adjust everything. Changes in accounting principles or changes in the reporting entity, you only have to adjust the years that are presented in the financial statements. So that can be 1 year, it can be 2 years if it's comparative financials, but that's the extent of it compared to error corrections. All right, and then just a sample note disclosure. So here you can see the narrative part, and it's just basically explaining that when you have a change in the component unit, you need to have a paragraph explaining really what happened, what kind of change. If you have an error correction, you need to disclose, what are the line items that were impacted and describe the adjustment. And then you have to also disclose a schedule that shows by reporting entity, whether this was a change in the reporting entity, a change in the accounting principles, or error corrections, and so on. So you can see here, for example, major and non-major funds will have some restatements when you have change in the financial reporting entity. So this is, again, it's going to be common. A lot of our clients have changes in major and non-major funds. So we're going to see that, like I mentioned, I've already seen a few clients where they're closing funds, opening new funds. Again, we're not saying you're opening a new fund by having a new revenue source would fall into that. We're just talking about opening a new fund to move existing operation from an existing fund to a new fund. That will basically fall under GASB 100 as a restatement. But of course, if you have a new revenue measure and you're setting up a new fund for it, there is no restatement. You just start accounting for the new measure in the new fund. So that's for GASB 100. Any questions? Yes?
The column won't be, if there's multiple error corrections, it's just an error corrections column and not like error correction 1, error correction 2.
Yeah, but you will have to disclose somewhere what the financial statement line items are. It is kind of if you think about it, it's going to get difficult to put it all on one schedule because you have your government-wide and your funds, then you have changes in accounting principles, error corrections. So where do you put the financial statement line items? You probably put them in the narrative part where you have a paragraph, you're describing what the error is, what the line items that are being impacted, and then you're just disclosing it on the schedule under error correction. So I would say that probably you can combine several error corrections, but you still have to disclose in the narrative what financial statement line items are being impacted and the impact and all of that. Okay. All right. So we're going to move on to GASB 101, compensated absences. So compensated absences is a leave for which employees may receive one or more of the following. Cash payments when the leave is used for time off, like basically somebody's taking a vacation. So they continue to get paid their salary. So that is cash payment when they use the leave. Other cash payments, such as payment for unused leave upon termination. So if you cash out your leave when you retire or you leave the organization. And then non-cash settlements, such as conversion to defined benefit post-employment benefits. So sometimes you have the ability to convert some of your vacation or sick leave to service credits, for example, with CalPERS. So really dealing with those types as well. I think one of the changes that, compensated absences in the past used to be just vacation and sick leave. And now it's expanded to include different types of leaves. So vacation, annual leave, sick leave, PTO, holidays, parental leave, bereavement, sabbatical, certain sabbatical. So for example, sabbatical leave during which an employee is not required to perform any significant duties, the unrestricted sabbatical leave is a compensated absence, same like a vacation. However, if you have a sabbatical leave where they are required to perform some duties, like for example, focusing on research instead of teaching, that is not considered to be a compensated absence. Yeah. So recognition and measurement. Liability should be recognized for the following. Leave that has not been used. This is really most of your liability. That is the leave that has not been used. Leave that has been used but not yet paid or settled. So this actually, when you think about it, what are the situations where leave was used and not paid? It's usually payroll accrual. Somebody went on vacation starting from June 20. You haven't paid them yet because the pay date is on July 5th. That is a liability. The leave is being used. However, it is really not going to be part of the compensated absence liability. It's just going to be part of your payroll liability. So to be honest, you're not going to have to worry about leave that has been used and not paid yet. I think that's just going to go to your regular payroll accrual. And then applicable salary-related payments. So that's new. That's something that GASB 101 is adding that didn't exist before. So let's talk about leave that has not been used. I'm sorry, I couldn't fix the animation on that. So it's just like, there you go. So a liability should be recognized for leave that has not been used if all of the following are true. The leave is attributable to service already rendered. So somebody already earned their vacation, their sick leave. The leave accumulates, meaning that it carries forward, it accumulates. The leave is more likely than not. The term more likely than not, as far as GASB is concerned, meaning more than 50% chance to be used for time off, paid in cash or settled in cash. So I think one of the most challenging parts of GASB 101 is figuring out what is more likely than not. That is going to be your biggest challenge, in my opinion, because not because somebody earned 100 hours of compensated absences, that does not mean that you're going to end up paying them 100 hours of compensated absences, because there may be situations where you would say, you know, based on history and trends over the last 10, 20 years, people only use 60% of the hours that they earned. And since we don't pay for sick leave when people terminate or retire, then we can assume that anyone who earned 100 hours of sick leave, they're probably going to use 60% of it. 40% will be forfeited. And that's what going to be the more likely than not to be paid. Is a little bit more involved than just a simple example. You have different bargaining units, they earn different type of compensated absences. They may have different trends where, you know, police officers may have different trends as far as how they use their sick leave and different leave compared to others. So really just figuring out how you're going to slice this. Are you going to look at it by employee groups, or are you going to look at it, you know, like government-wide or organization-wide? But really figuring out what's more likely than not to be paid is going to be, in my opinion, the most challenging part in that. So how should you evaluate whether a leave is more likely than not to be used for time off, paid in cash or settled in non-cash? By assessing the following: your employment policies, whether leave that has been earned is or will become eligible for use or payment in the future, historical information about the use, payment, and forfeiture of compensated absences, and information known to the government that would indicate that historical information may not be representative of future trends or patterns. So not because this happened in the past does not mean it will continue to happen. If you know of information that makes that untrue, then obviously you have to take those into consideration. But again, this is not something that you have to develop every year, because you're really looking at trends and history. So I think you just have to develop it once, and then every year just looking at it to see, are there any information that indicate that those trends may be changing or require adjustments. But that first year of implementation, figuring out how are we going to determine what's more likely than not. I hope that you don't say, well, you know, more likely than not, we're going to pay 100%. I mean, that's an easy way out, right? But, you know, I think we too going to probably question, you know, like, how is it possible that you're paying 100% of it? Like everybody in your organization uses every single sick day that they have. And I mean, we encourage people in our firm, go take your time off. Mitesh was just telling me that we don't account for compensated absences on our balance sheet because we feel that, you know, people take them off. The liability is usually very insignificant. But of course, in your situation, like I know of several clients where there are some people that have a lot of time off. Some clients also brought up good questions, said, you know, well, how do you look at a group when you know, for example, like in finance, there's one or two individuals that are really at the top of the chain as far as compensation and all of that. And they have tons of vacation. They never go on vacation because you guys probably know you're very busy. You don't have time to go on vacation. So should you stratify those people from the rest of the group? It's going to be up to you. This is an estimate. There are no hard set rules on how you develop that. It's an estimate. So you really just need to make sure that you have a reasonable basis of how you're developing that amount. You know, we're going to be flexible, obviously, as long as we feel it's a reasonable basis, it's supported by history and trends. That's all we're going to be looking for. All right. So leave that is more likely than not to be settled through conversion to defined benefit, post-employment benefits should not be recognized as a liability for compensated absences. So if you determine that a portion of your vacation normally gets converted to CalPERS credits, that portion should not be part of your compensated absence. And the reason for that is because CalPERS and pension are accounted for under different standards. So anything that goes into the plan, even service credits that were, purchased or converted by using your PTO, they will be captured as part of the CalPERS valuation. Your pension liability eventually will reflect those. So you don't really have to worry about it. All you have to determine is that if 10% of our vacation hours are going to be converted to service credits, those 10% should not be accounted for. They're not part of our compensated absences. For compensated absences that are dependent upon the occurrence of a sporadic event, such as, military duty, for example, or parental leave, there are no liability to be accounted for. The liability is only accounted for when the event happened. When you have a baby and you go on parental leave, this is when the liability gets recorded. Military leave, jury duty, all of those, when you are actually requested to appear, this is when the liability should be recorded. For the following type of compensated absences, a government should not recognize a liability until leave is used. Leave that employees are able to take as needed without specific limits. Unlimited leave. It's probably a lot of you understand that it's a very tricky term, because usually when you have unlimited leave, that means you actually don't take that very much time off. It's very easy for employers to say unlimited because they know that you cannot go unlimited. I have unlimited leave. I can tell you that, I don't go unlimited at all. So unlimited leave is really not something that should be part of your liability. And also holiday leave that is taken on a specific date, not at the discretion of employees, is also not a liability. One of the things that when we talk about GASB 101, first time I heard about it, there were two people making the presentation, a CPA and a lawyer. There are definitely a legal factor to it, what constitutes a leave, and it's not all accounting. Another thing that you have to consider is what they call constructive receipt, something that is not addressed really in the GASB because it has nothing to do with accounting. But for those of you who don't know constructive receipt is an IRS thing where basically it says that if you have access to something, you consider to have earned it. So if you have the option to cash out your vacation and you're choosing not to, you may need to pay taxes on those because you are considered to have received them. You're just choosing not to. It's almost like, you got a check and you chose not to deposit it. You still have to pay taxes on it. So just keeping that in mind when you're looking at your policies that, I know one city that I was just talking to and said, oh, we made sure that we changed everything, that there are no constructive receipts, that there are no ability to cash in while you're still employed. Because if you have that option, if you have the option to say, I'm going to take cash now, and you're choosing not to, from the IRS perspective, they're looking at it that you earned this, you should pay taxes on it. You're choosing not to use it. So that's different. So just keeping that in mind, you're not going to find it in the GASB statement. They don't talk about it, but it is definitely an issue that you may want to have that discussion internally. Liability should be measured using the pay rate as of the date of the financial statement, except for some or all the leave is more likely than not to be paid at a different rate. If you know that for sick leave, we don't pay, we pay only 50% of the rate. So you already know that, the rate that is being used currently is not what you're going to use to pay for. Or, for example, the leave is not attributable to a specific employee. If you have a shared pool, leave pool, then you will have to come up with what is the pay rate that would be representative of the pool. to calculate the liability for that. Some of the leave is more likely than not to be settled through non-cash means other than conversion to defined benefits, post-employment benefits, and should measure the liability based on the estimated settlement amount. So if you have a non-cash settlement, not CalPERS service credits, then you would just have to figure out, well, what is the value of those non-cash settlement, and that should be the value of your liability. Changes to the measurement of the liability in future periods due to a change in pay rate should be recognized in the period of the change. So you don't really need to go back and restate anything just because the pay rate changed. You just basically change them when the change occurs. All right. So now leave that has been used. Again, this should be reported when the leave is used for the time off, but has not yet been paid. So this would be your typical payroll accrual. The liability, including any applicable salary-related payment, should be measured at the amount of the cash payment or non-cash settlement to be made. And then this is another important part of GASB 101. So the first important part was really calculating the more likely than not. Okay. Second important part is the salary-related payments. So that's another part that most of our clients, at least, don't account for it. I was surprised to find out that we actually had 2 clients that accounted for it. And for no reason, they felt that this is a more representation of the true liability. So they were a little bit ahead. So salary-related payments are obligations that a government incurs related to providing leave in exchange for services rendered. The term salary and salary-related payments represent any pay provided to the employee, whether it's a fixed amount or an hourly wage. Examples of salary-related payment will include employer share of Social Security and Medicare taxes. So it can be many other things, like if you make contributions to a 457 plan, for example, as you make salary payments to employees, that's a salary-related payment. If somebody uses their vacation, you're still making those contributions to their deferred comp plan when you're making their salaries. So your compensated absence liability should include any FICA. I know most of you don't pay FICA, but any other type of taxes that the employer has to pay, any deferred contributions to deferred comp plan or a 457 plan, any type of related payments that you normally pay with payroll, with people cashing their vacation, will have to be part of your liability. So liabilities for compensated absences include salary-related payment that are directly and incrementally associated with the leave. So what do we mean by that? A payment is directly associated if the amount of the payment is a function of salary to be paid. That is, the amount of the payment depends on the amount of the salary. So that is like the tax amount is usually related to what the salary amount is. The higher the salary, the higher the tax. The higher the salary, the higher the contribution. So it has to be directly associated with the salary. It also has to be an incrementally associated with salary, meaning like in addition to the salary. That is not part of the salary. That has to be in addition to the salary. So if it's directly associated and incrementally associated, then it's a related payment, and it has to be part of your compensated absences liability. A salary-related payment may be incrementally associated only with a portion of the recognized leave. So yeah, for example, if that deferred comp contribution, you only do it to active employees. So when someone uses their vacation, you're doing deferred comp, so you're accruing the salary-related payment. But if somebody were to retire and they're cashing out their vacation, maybe your policy is not to do contribution for those types of payments. So if you're looking at it and saying, okay, we anticipate that 60% of the hours are normally used for vacation, 40% are cashed out. So 60% of the hours should have related payments relating to contributions to the deferred comp plan. 40% of the hours should not have that related payments. So that's what they mean by portion may have the related payments, another portion may not. Again, these are all the rules that you're going to set at the beginning of the year. What is more likely than not? which ones are going to have related payments, which ones don't have related payments. You really need to set up these formulas. So then when you calculate here are my hours, here are my rates, what are the percentages that I should apply related payments on, the ones that I shouldn't apply related payments on, which ones I should not even include in the liability because we don't anticipate we're going to have to pay for them. So those are really the challenges of GASB 101. I don't say challenges, those are basically the work that you have to do to comply with GASB 101. I'm sure that most of you, if not all of you, have ways of looking at these trends, running reports, seeing what was used in the past, and so on. For leave that has not been used, expenses for salary-related payments related to defined contribution, pension, or OPEB should be recognized when the liability is recognized and should be reported as pension expense or OPEB expense. They should not be reported as pension liability or an OPEB liability. So basically what we're talking about here is if you're making contributions to like a deferred comp plan, the expense side of it, because you're supposed to accrue it as part of your compensated absence liability, the expense side of it should just go to a pension expense or an OPEB expense. For leave that has been used, salary-related payments related to defined contribution pension should be included in pension liability or an OPEB liability. In this case, if you have an employee who used their vacation, went on vacation, and you're supposed to pay them their salary, including related payments, the contribution to a deferred comp, but you haven't made that payment yet because it's not due yet. Like it's July 5th, the payment, and your fiscal year is June 30. Then GASB 68 also covers the deferred contribution plan, saying if you were due to make a contribution and you didn't make it, that's a liability on your books. So even though you don't have a long-term pension liability, but you have a liability for the contributions that were due that you haven't paid yet. So that's really what we're referring to. And then salary-related payments related to defined benefit pension and or OPEB should not be included in the measurement of liabilities for compensated absences, as if even if they are directly and incrementally related or associated with the leave. So if we're talking about your regular pension plan, your defined benefit pension plan, any contributions you're making, those have nothing to do with compensated absences. Should not be part of related payments or anything like that. All right. Notes to the financial statements. That's the only thing that they simplified in GASB 101. The notes is easier, actually. In the past, you used to be required to show additions to compensated absences and then retirement. Now you have the option to just show them as net. I think most of you are already plugged the number anyways, because just the information wasn't that readily available. So a lot of our clients will say, well, we know what the additions are, or we know how many hours people earned, and then we just assume that the deletions is the difference. So now you don't have to do that. You know, you are allowed to report it net. But you can still do additions and deletions if you would like. You don't also have to say which fund will typically liquidate the liability. So this is how it will look like. So you will have the option to just show a net of the liability instead of additions and deletions. Yeah. So just a small simplification of the note disclosure. All right. So now we move on to GASB 102 and 103. 102 is very simple. And it makes really a lot of sense to disclose that. So the purpose of 102 is that governments are vulnerable to a variety of risks, and some of the risks are required to be disclosed because of existing standards that requires you to disclose some of those risks. However, other prevalent risks are not routinely disclosed because they're just not required to. So GASB 102 is really trying to generalize risks and identify criteria that if they are met, then they require you to disclose some information about some of these risks. All right, so two things that GASB 102 is referring to as risks. First one is, well, I mean, maybe I'm moving ahead of myself. So government may be vulnerable to risks from certain concentrations or constraints. So concentration is the first thing we want to look at, and then constraint. Those are the two areas where basically 1 or 2 is saying that government may be exposed to some of these risks relating to concentration or constraint. So a concentration is a lack of diversity related to an aspect of a significant inflow of resources or outflow of resources. For example, you have a Home Depot in your city pays 40% of your sales tax. That's a concentration. You have Tesla as your main employer in your city. That's a concentration. If Tesla leaves, you will have a lot of unemployed people. You will have less taxes, less property taxes, less many things from having that employer leave. So that's just the concentration, but also you can have constraint, which is a limitation that is imposed by an external party or by a formal action of a government's highest level of decision making, like your city council, for example, issuing a resolution or an ordinance, basically imposing constraints on certain funding sources. So examples for concentration. These are just some examples of concentration. Employers, if you have one main employer in the city that basically hire half of your population. Industries, if you're heavily reliant on a specific industry, like tourism, for example, or something like that. Inflow of resources, sales tax, if you're heavily dependent on one payer. Workforce covered by collective bargaining agreement. I think a lot of you may have that if, provider of financial resources. We have those clients. We have a client that basically 100% of the revenue is a grant from the federal government. So that's like, if there is no grant, there is no client. Suppliers of materials, labor, or services. Suppliers can be a big concentration risk. If you're really heavily dependent on certain supplies and it only comes from one, they definitely have a lot of impact on you. Also constraints, which limitations on raising revenues. If you have legal limitations or your governing body impose restrictions on your ability to raise revenues. Obviously, as some of you know, there was that business roundtable, can't remember the exact name, but they had a group of businesses who really wanted to curb government ability to raise any taxes, any fees, anything. Luckily, got defeated. Good for you. But that would have imposed a lot of restrictions on how you can raise revenues. Limitations on spending, limitations on incurrence of debt, mandated spending. Sometimes you are mandated to spend on certain programs. So these are also constraints. So all of these are risks that you may be vulnerable to, but not just because you have one of those doesn't automatically mean you have to disclose it. So there are criteria for disclosure, and you have to demonstrate that those criteria have been met. First, it's applicable to the primary government and its blended component unit, all reporting units that report a liability for revenue debt. So it's not just, if you're a city, for example, it's not just your city, but also any reporting unit within your organization, like, for example, a water fund that have a revenue debt, then you will have to cover that. Disclosure is required if all of the criteria below are met. Concentration or constraint is known to the government prior to the issuance of the financial statement. So you already know you have a concentration or a constraint. The concentration or constraint makes the reporting unit vulnerable to the risk of a substantial impact. So you can have a concentration, but you don't really believe that it will have a substantial impact. But if you do believe that I have a concentration and it can have a substantial impact, and also an event or events associated with the concentration or constraint that could cause a substantial impact have occurred, have begun to occur, or are more likely to occur to begin to occur within 12 months from the date of the financial statements are issued, not from June 30, but from the date you're issuing the financial statement. So if you're issuing in December, you have 12 months. If you think it's going to happen in the next 12 months, You need to talk about it. So what are those? Like, for example, I have a client where they have a really big retailer that pays a lot of their sales tax. One of them, they know the retailer is leaving. They know that they're not renewing their lease. So that's an event that has occurred that will have a substantial impact. You also can have an event, another client who have a big retailer where the state initiated, basically, it's the typical, are you supposed to get the sales tax? If you're a distribution center, who's getting the sales tax? Is it you, or is it the person who lives in Kotati who purchased it online? Of course, you know, Kotati is going to say, of course, the person who's living in Kotati. But the client who built all the infrastructure to have the warehouse and the distribution center will be like, of course, it's us. We built the infrastructure. We made this happen. But anyways, that's not the discussion here. But the discussion here is that if you get notified, then the state is looking to take those sales tax away, and that will have a significant impact. Then you can have that concentration that you're relying on that retailer. It can have a substantial impact. And now you know that the state is looking into basically taking this money away. So that can be a situation where you will have to disclose that. If mitigating actions taken prior to the issuance of the financial statements cause any of the disclosure criteria not to be met, none of the disclosure is required. So you do have opportunity to take action and prevent that disclosure from being in the financial statements. However, actions are different than plans to take actions. There needs to be actual actions that we're taking. So the disclosure principles that you should keep in mind: if comparative financial statements are presented, the reporting requirement only apply to the financial statements of the current period, which makes sense. I mean, I think it would be irrelevant talking about concentration of the prior period. It's either existing in the current period, or if it's not existing, then it's not a concentration anymore. Certain disclosure required may supplement note disclosures required by other guidance, should be combined to avoid duplication. So for example, that situation about sales tax was one of my clients. It's actually part of a discussion about tax abatement, where they have that retailer, they're saying, okay, you're bringing us all the sales tax, we pay you a percentage of it. So if you already have that note, and now you're talking about a concentration risk with that retailer, you may want to incorporate them in the same place. You don't want to have duplication. It can be incorporated in other existing notes. Information that is the same for more than one reporting unit should be combined in a manner that avoids unnecessary duplication. So if you have that concentration for, you know, your primary government and for your rent board, who is a discrete component unit, and it's the same concentration risk, you don't want to disclose it twice. You just want to have it one time. And then disclosure relating to discretely presented component unit is subject to the requirements in paragraph 63 of statement 14, basically saying that, you know, you can have 10 discretely presented component unit, but which ones are really the more significant, or that the disclosure will be required for them? GASB 63 talks about the relationship of the component unit to the primary government and the significance of the relationship. So it's not purely dollar amounts, but it's also the impact and the nature of the relationship with the primary government, which basically means that you can have 5 different discretely presented component units, but you may determine that really only 2, the concentration risk, will actually be relevant and significant to the primary government, and those would be the ones that you would disclose. All right. So you are supposed to provide information in sufficient detail to enable users to understand the nature of the circumstances, disclosing the government vulnerability to the risk of substantial impact. You have to disclose the concentration or constraint itself, each event associated with the concentration or constraint that could cause a substantial impact, if the event had occurred or had begun to occur prior to the issuance of the financial statements. If the event never occurred, there's really nothing to disclose. Like if you just feel, okay, we have concentration, it can have a substantial impact, but no events occurred, There's not really nothing to disclose. If an event occurred, but you took action to mitigate that prior to the issuance of the financial statements, still nothing to disclose. Actions, no plans. So it has to be actions. You cannot say like with going concern, or we are going to do this, we are going to do that. It has to be things that you actually done to mitigate that prior to the issuance of the financial statements to mitigate the risk. That's it for 102. So it's really it's very simple. A lot of you may not deal with it. If you don't identify that you have those constraints or concentrations, and you don't have any of those criteria, then you don't have to deal with it. Yes. Not reaching an agreement, maybe. People are not going to work. You're not able to reach an agreement with them. That can be a concentration that will have a significant impact. Like I would think, for example, you know, the airline industry, if they have the pilots having no agreement, I would think that would be a substantial impact on them. So I would say things of that nature. Sure. All right. So I think we're doing okay on time. So financial reporting model improvements, GASB 103. Again, simple, very few changes, a lot of focus on the MD&A, but quite frankly, nothing new, things that you were supposed to be doing anyways. But clearly they decided to put it in GASB 103 because they felt that maybe not a lot of you are doing that. So in any case, I think it, you know, we are lucky they were going in a very different direction where this GASB 103 would have been the new GASB 34. It would have really made a lot of changes. They were thinking about changing the measurement focus of the governmental funds, changing the modified accrual basis, coming up with a new basis, focusing on short term and, you know, near term, and really just coming up with a lot of stuff. Every time GASB come up with a standard, they are trying to achieve what they call conceptual consistency. And they felt that with the fund, governmental funds specifically, that there were so many exceptions to what will qualify in the near term and short term that it would just defeat the whole purpose of being able to have conceptual consistency. So they decided that it was just not going to be achieved, and the cost benefit of trying to do it was not there. I mentioned that, and probably some of you already said in presentations in the CSMFO conference and in other conferences about the new financial reporting model, the governmental funds changes, and then they decided not to pursue any of them. Maybe those presentations were the reason why they decided not to pursue any of them, but they definitely got a lot of feedback and input that made them back out. So I think we should be glad because I felt that it would have complicated the report even a lot more than it's already complicated. So in any case, so let's talk about 103 and what it covers. Establish new requirements or modify existing ones for the following: MD&A, the unusual or infrequent items. So that's a new definition. That's a new item. Presentations of the proprietary fund financial statements, statement of revenues, expenses, and changes in fund net position. So the income statement of your proprietary funds, your enterprise and internal service funds, will change a little bit, not by much, but it will change a little bit. Also information about major component units in the basic financial statements. Budgetary comparison information, that's going to change a little bit, and that's going to be interesting. I think it's changing to the better when we get to it. And then financial trends information in the statistical section. So these are the areas that are covered by GASB 103. I would say that the MD&A is the one that they give it a lot of focus. So let's start. MD&A, some basic principles that you have to keep in mind when you're preparing your MD&A. It's supposed to provide an easily readable analysis based on currently known facts, decisions, or conditions as of issuance date. So currently known facts is going to be a focus. We don't want to talk about the future. We don't want to talk about plans. We don't want to talk about hopes. We want to talk about currently known facts in the MD&A. Written in a manner that can be understood by users with no detailed knowledge of government accounting. That's the whole point of the MD&A, is that it is designed for individuals who are not accountants or don't want to read all the detail of the accounting stuff. So it's supposed to be an easy to read, easy to understand document. Focus on current year compared with the prior year with emphasis on current year. So definitely the emphasis has to always be on the current year. Avoid duplication. We're going to talk a lot about that. They really want to make sure that you're not repeating the same explanations over and over again. Explanation for the government-wide can be exactly the same as the explanation for the general fund. Same factors contributed to the increase in revenues, increase in equity. You don't need to repeat that under the government-wide and the general fund. You have to really try to avoid duplication. And then focus on the primary government and distinguish between the primary government and discretely presented component units. Keep in mind, MD&A is supposed to focus on the government-wide more than anything else. The primary government, the government-wide, then the major funds. So you cannot skip the government-wide. I know some of you, because, or maybe not here in the room, but some of our clients, maybe they don't see the government-wide as a very useful statement and they focus more on their funds. But unfortunately, when you're preparing your ACFR, you have to focus on the government-wide. That is the main focus. So what should be in the MD&A? We have seen so much variety in the MD&A. And I'm glad that they're making that adjustment, because now they're telling you, please keep it to those topics. Don't venture out. Don't talk about the future. Just keep it to those topics. Okay. You can talk about other things in other places. Transmitter letter is a perfect place for that, but not in the MD&A. So what are the topics that needs to be in the MD&A? Information presented should be confined to the topics discussed in the 5 sections outlined below. Overview of the financial statements, financial summary, detailed analysis, significant capital assets and long-term debt activities, and currently known facts, decisions, and conditions. And they actually provided a lot of criteria, because this is really where people just go all out, is those currently known facts, decisions, and conditions. They basically tells you everything they know. And sometimes are even things that didn't happen, that they're hoping is going to happen in the future. So this is really getting to a point where, like, these are just currently known facts, and they're giving you examples and criteria, but what do they mean by that? Okay. All right, so we'll talk about each one of them. Overview of the financial statements, that's an easy one. You're basically describing the financial statements. You're describing what's in the basic financial statements, the relationship of the statements to each other, the governmental funds to the government-wide, to the enterprise funds, and also what information or the differences in the information provided in each one of them. So, whether it's modified accrual versus full accrual, or this providing for the business type activities versus the governmental activities. So just providing those, it's the first part of the MD&A, and it's a narrative part saying, we have the government-wide, those are how they're prepared. We have the fund financials. These are the type of funds. We have these major funds. Just a description of what the basic financial statements are. Then you have financial summary and condensed information derived from the government-wide. Compare current year to prior year for both governmental and business type activities. Provide information needed to support analysis of financial position and results of operations. So this is really, those are your schedules that compares the prior year to the current year. It also provides the changes percentages. So those should be the basis. These are the things you're going to need to explain in the next section, analysis. When you look at the schedule, you're going to see all these percentages change. And that's what you're expected to explain, is why are those changes occurring? So financial summary elements to be included will be total assets, and you have to include capital assets and other assets, total deferred outflow of resources, total liabilities, which will have long-term and other liabilities, total deferred inflow, net position with its categories. So that's on your balance sheet side. These are the minimum categories that you have to have in the condensed comparative information. On the statement of activity side, sorry, it's a little small here, but because there are many items, program revenues, and you need to have charges for services, operating grants and contributions, and capital grants and contributions. General revenues by major source, property taxes, sales tax, so on. Total revenues, program expense by function, general government, public safety, public works, so on. Total expenses, excess deficiency before contributions to term, permanent endowment, or permanent fund principal, transfers, and unusual or frequent items. So we have so many categories now that, I mean, we'll display them, so hopefully it will be more clear, but basically that's how your statement of activities will look like. Then you would have contributions to term and permanent endowments or permanent fund capital, then transfers, then unusual and or infrequent items, beginning net position, change in net position, ending net position. So remember, these are the categories you have in your statement of activities in the government-wide. You know, your program revenues, general revenues, program expenses. Then you have contributions to term, permanent endowment, and permanent fund capital. Those are, it's a new category in the proprietary fund called non-capital subsidies. And it will include contributions to endowment and so on. Then transfers, then unusual and infrequent items. So unusual and infrequent items are replacing special items and extraordinary items. So that's a discussion topic we have. And then your beginning balance, changes in net position, and ending balance. So those are the categories that you should have in your table in the MD&A that compares the prior year to the current year. Those are the minimum that you're supposed to have. All right. Not sure why this came up this way, but for the detailed analysis, so this is a big part of GASB 103, is that clearly GASB does not like the analysis that they see in ACFRS. They're just not providing enough information. So now they're giving more instructions on how you should provide analysis. So for the government-wide, you need to provide significant changes to governmental and business type activities. You need to explain why changes occurred and their magnitude, the why, not just the what. And this is really critical. Cannot tell you how common this is, that we read an MD&A and we are looking at the analysis, and the analysis is usually, well, revenue increased by 10%, expenses increased by 5%, therefore equity increased by this percent. But there's really no information. I mean, we can see that from the table that revenues increased, expenses increased, but where's the why? Why did revenue increase? What were the main factors that contributed to that revenue increase or decrease? And same with expenditures. And that's what GASB wants you to focus on, is the why. Why are things changing, not just the what? Okay. Includes facts, decisions, and conditions that users may not be aware of. The MD&A is your opportunity. You as a financial manager, you know the numbers, you know the fiscal policies, you know the risks that your government is exposed to. This is your place to provide facts that the user may not be aware of when they're reviewing your financial statements. Discuss policy changes and economic factors that significantly affected operating results. So we're really talking about what happened during the year. What were the policy changes or factors, economic factors that impacted the operating results? Similar to the government-wide, you need to provide an analysis of the fund financials, and it's going to focus mostly on the major funds. Again, significant changes to each major fund. Explain why changes occurred and their magnitude, the why and not just the what. Include facts, decisions, and conditions that user may not be aware of. Discuss restrictions, commitments, or assignments that significantly affect the availability of fund resources. So, you know, you may have a general fund that has $100 million fund balance, but if you have all these restrictions and commitments to fund balance, you want to discuss that, saying that, yeah, you know, there's not a whole lot available. It's already committed and restricted for other purposes. Should also focus on explanations that differ from the analysis of the government-wide. So again, focusing on not duplicating. The more redundant you are, the more you're duplicating, the less valuable that document becomes, because people start saying, oh, you know, I read this before, they start skipping, and then it just starts losing its value. So here they want you to focus on any analysis that are different from what you already provided in the government-wide. Because keep in mind, the government-wide is also coming from the fund statement. So a lot of the analysis that you're doing in the government-wide are probably similar to what you're going to provide to the fund statement. You may want to focus more on something that is unique to the general fund or unique to one of the major funds, but not necessarily just repeat the same analysis that you did for the government-wide. So that's for the detailed analysis. Then we have significant capital assets and long-term debt activities. And for capital assets, that's what you should have. Significant capital assets activities during the year, including certain intangible assets. So that's one area that I see a lot of you missing. Your SBETA assets, your leased assets from GASB 87, they are capital assets, at least for now. There is GASB 104 that hasn't been issued yet, that is being discussed. It will be issued probably in September, in a month or two, about classification of non-financial assets. GASB wants to look to make sure we're classifying non-financial assets like capital assets and SBETA and leases the right way. So as of right now, they're still part of the capital assets. They should be part of your discussion in the MD&A. Significant additions and disposals and changes to commitment made to acquire capital assets, significant policy changes, should not duplicate analysis from the government-wide. So if you already talked about some capital assets activities in the government-wide, no need to duplicate that here, only the things that are unique to the capital assets. And same with long-term debt. You want to talk about significant long-term financing. Don't forget leases, triple Ps, the public-private partnerships. There's betas, they are part of your long-term debt. Agreements entered into, changes in credit ratings, changes to debt limitations. All of these things are things to discuss in the MD&A. Significant policies changes, and try not to duplicate information from the government-wide and the major fund. And then currently known facts, decisions, or conditions. A description of currently known facts, decisions, or conditions that are expected to have significant effect on the financial position or that are expected to produce significant differences from current period results of operations. And then some examples. Trends in relevant economic and demographic data, such as changes in population, customer base, income levels, building permits, enrollments, unemployment rates. Relevant factors used to develop the subsequent year budget that will provide an indication of how results of operations are expected to change in the subsequent year, such as changes in tax rates, fee amounts, economic basis, inflation. Expected changes in budgetary net position or fund balance, actions that government has taken related to post-employment benefit liability, capital asset plans, lease liability, basically renegotiating leases, extending leases, pre-funding pension, those types of things this is a place to discuss them. Actions other parties have taken that will affect the government in a subsequent period, such as new legislation or regulation imposed on the government. One thing that is actually missing from here that you no longer have to discuss is the modified approach for infrastructure. I know most of you don't use that, but I know a few of our clients use them. And there used to be a requirement to discuss the infrastructure condition and so on in the MD&A. And now you don't have to do that. The only place you have it is in the RSI, but not in the MD&A. It used to be in both. So this is it for the MD&A. So I would say the takeaway for the MD&A is really nothing new here, except you need to do better analysis, focusing on the why, and that you should keep it to those 5 topics. You should not venture out in other topics. You can do that in the transmitter letter and other parts of the report, but in the MD&A, it should really stay within those 5 topics. So I would say those are the main takeaways on the MD&A. So now moving on to unusual or infrequent, item. And some reason my animations didn't work last night on that. So it was too late for me to try to fix it. But in any case, so I like that definition. Unusual or infrequent items are transactions and other events that are unusual in nature or infrequent in occurrence. So it's a very, self-explaining. But that's really what you will see. Also, the operating revenues definition. Operating revenues are any revenues that are other than non-operating revenues. So if you go to non-operating revenues definition, then I'm sure there will be items other than operating revenues. But in any case, they did give some guidance on how to identify those. So unusual nature means it possesses high degree of abnormality and be of a type clearly unrelated to or only incidentally related to the ordinary activities of the government, taking into account the environment in which the government operates. Infrequency of occurrence would not reasonably be expected to occur in the foreseeable future, taking into account the environment in which the government operates. So if you recall, we used to have what we call special items and extraordinary items. And special items were the items that management was able to control the situation, or was under management control, versus extraordinary was not under management control. They both are unusual in nature and infrequent in occurrence. But just to give you an example, that GASB, when COVID-19 happened, GASB said that's not an extraordinary item or a special item. It is not unusual in nature or infrequent in occurrence. Pandemics happened before, and they will most likely happen again. So just giving you an idea about how high the bar is, that not everything that definitely a drop in revenues of 5% is not unusual in nature or infrequent in occurrence. But just letting you know that when we asked GASB, would you consider GASB COVID-19 to be an extraordinary item? They said no, it is not unusual in nature or infrequent in occurrence. So just keeping that in mind. You can have a flood, for example, and that can qualify as an unusual in nature, infrequent in occurrence. But that's what they mean by considering the environment in which you operate. If you live in a flood zone, if you're in a flood zone and flood happens every year, well, that's not infrequent in occurrence, and it basically not going to qualify under those infrequent and unusual items. So there's going to be a lot of professional judgment there in determining an item that may be infrequent in occurrence for one entity may not be for another entity, and vice versa. So professional judgment will have to be used. So now they should present those items as the last flow of resources prior to the change in net resource flows. And I'm going to show you an example, but basically you have operating revenues, non-operating revenues, you have transfers, you have all of these things. And then at the bottom, you're going to have those infrequent and unusual items. Inflow and outflow related to each unusual or infrequent item should be presented separately. So if you, for example, if you have an unusual item or infrequent item, flood, for example, where you had damage, you have proceeds, grant or insurance or whatever, you cannot net the two. You need to have two separate line items, one for the inflows, one for the outflows. Yeah. And then should disclose the program, function, or identifiable activity to which an unusual or infrequent item is related, if applicable, and whether the item is within the control of management. So this is how it would look like on a government-wide. You can see the highlighted items all the way at the bottom, right after transfers, all the way right before the change in net position. This is where unusual and infrequent items would be reflected. This is the same position where extraordinary item and special items also used to be presented. So now instead of special and extraordinary, you have unusual and infrequent. Okay. And then you will also, if you look at your governmental funds, for example, this is how it will look like. So after other financing sources and uses, you will have unusual and infrequent items. So right before the change in fund balance. Okay. No disclosure. Basically, you need to disclose whether this is something that was under management control and just really describing what the item is. So in this case, you have a catastrophic event outside the control of management. So we're stating that this is not under management control. The city incurred expenses to clean up the flood damage in the amount of 10 million and received to the function of public works and public safety in the amount of 8.3. So basically, you're saying which functions or departments have been impacted or this relates to, and then that you received 2.5 million in grants. And I think yeah, so basically, and this is reflecting these numbers, the 2.5 and the 10 million, the cleanup cost. Okay. So you have to have a note disclosure that goes along with it, not just a line item on the financials. So in the past, we didn't used to have a requirement for a note disclosure. All right, now we move on to presentation. I'm probably still gonna run a few minutes late. Yes, sir.
Some of the lawsuits may continually affect, future operations. However, if the agency is vigorously defending those lawsuits, how much information should you disclose in MD&A surrounding those particular litigation areas?
Well, again, it's currently known facts that you think will impact or will basically have an impact on future period compared to the current period. If you feel that the litigation is a legitimate litigation with, high probability that this will occur, then yeah, you should probably discuss it. If you recall that in recognizing events in general, even from an accounting perspective, we look at an event that is reliable, meaning that either occurred or have a high probability of occurring. So it would be the same scenario. If you have a litigation and you feel it will have a significant impact on future results compared to the current year results, and that is highly probable, then it should be disclosed.
You might come into a disagreement with the attorney who's defending you. They may.
Well, I mean, attorneys can say what they want to say. I mean, we're not preparing the financials in accordance with the attorney's opinion. We're preparing it in accordance with GAAP. I don't think that you have to provide specifics about what the lawsuit is against who, or those details. You can just have it in general terms that this is really have an impact without necessarily getting into the detail. Okay. All right. So luckily, the remaining parts are just they're fairly quick. So this is a change in how proprietary funds financial statements should be displayed. So enterprise funds, internal service funds, and they are distinguishing between operating and non-operating revenues and expenses. Separately report non-capital subsidies. So that's a new category called non-capital subsidies. We didn't have that before. Present the following information in the order shown using all the inclusive format indicated. So operating revenues in detail, total operating revenues, operating expenses in detail, total operating expenses. Then you have operating income or loss. Then you have non-capital subsidies in detail. Then total non-capital subsidies. Then you have operating income or loss and non-capital subsidies. And you have other operating revenues and expenses, as other non-operating revenues and expenses in detail. Then the total other non-operating revenues and expenses. Then you have income or loss before unusual or infrequent items. Then you have unusual and infrequent items. Then you have increase and decrease in fund net position beginning of the period, and then fund net position end of the period. These are the categories you are required to have in a proprietary fund income statement, in an enterprise fund income statement. These are the categories that you are required to have. Unless, of course, you don't have infrequent items, then you wouldn't have that category. But assuming you have them, this is the order. Those are the categories that you need to have. These are the totals and subtotals that you're supposed to have. Yeah. So let's talk a little bit about definitions. Operating revenues are and expenses are operating revenues and expenses other than non-operating revenues and expenses. It's a very informative definition. Then you have non-operating revenues and expenses. And this is an interesting one because this is non-operating revenues and expenses. We used to put anything that we don't think is operating, you just dump it in there. So now they're basically, again, this conceptual consistency. So they are giving you specific instructions on what qualifies as non-operating revenue. If it's not within those, it is not a non-operating revenues. And subsidies received and provided, these are non-operating revenues. Even though we have a separate category called subsidies, they are still considered to be non-operating revenues. So we have subsidies and then we have other non-operating revenues. So subsidies is part of non-operating revenues. Contributions to a permanent and term endowment. So that can be contribution to, for example, a permanent fund that will also qualify. Revenues and expenses relating to financing, interest income, interest expense, relating to financing. Resources from the disposal of capital assets and inventory, and investment expense and income. Anything that does not fall in those categories is not considered to be non-operating income. So that's going to open up the room for a lot of stuff. Like, for example, you have insurance proceeds was non-operating income under those categories. So what is it? Well, you hope that it's going to qualify as infrequent and unusual item, because if it doesn't, there's really no other place left other than operating income. You know, if you have a flood every year and you're dealing with it every year, well, guess what? It's part of your operating expense, right? You know, it's just part of doing business that you have to deal with flood every year. This kind of concept of looking at operating versus non-operating. So just keeping in mind that those are now set rules. If it's not one of those, it's not a non-operating revenue or expense. Okay. Then you have subsidies. And subsidies, you can have subsidies received or provided. And for subsidies received, the definition is for which the proprietary fund does not provide goods or services, and that directly or indirectly keep the proprietary fund current or future fees lower than they would be otherwise. So basically, you're receiving money, not in exchange of service provided. You're just getting money. And if you don't receive those funds, your fees in the future would have been higher. That the part of you receiving those funds is actually keeping your fees low. So that would be considered a subsidy. Also, if you are giving out a subsidy, it has to be for which the other party or fund does not provide goods or services, so you're not getting anything in return, and then that are recoverable through the proprietary fund current or future pricing policies, meaning that if you're basically a water fund and you're giving subsidy to another fund, that subsidy amount has to be covered by your existing fees, meaning like your fees are sufficient to cover your cost and the subsidy that you're giving out. Not just using your existing fund balance without being able to recover those subsidies from your fees. And then all other transfers, all your regular operating transfers in and out also fall under the subsidy definition. Transfers are subsidies. Okay. So again, this is a change for proprietary funds. Definition of operating and non-operating revenues, adding the non-capital subsidies. So these are all new things for proprietary funds. right? So revenues and expenses that otherwise would be classified as non-operating in most proprietary funds should be classified as operating revenues if those transactions constitute the proprietary fund's principal ongoing operation. So for example, if you have a proprietary fund that account for housing loans or and basically you have interest on these loans, that the interest income would not be considered non-operating revenue. It will actually be considered operating revenue because they are directly related to your operation. They're not investment income at this point. So just keeping that in mind that operating is really as it relates to you. For example, interest revenues should be reported as operating revenues by proprietary. Oh, that's what I just said, so I'm not going to read it again. All right, and then this is how your proprietary funds will look like. Actually, you can add one more category here, the infrequent and unusual item right after the non-operating and right before the change in net position. So these are the categories you can possibly have. You can see the non-capital subsidies. So now it sits here. Transfers used to be at the bottom. Now they're not at the bottom. And intergovernmental revenues like grants and things like that and transfers in and out will fall into this non-subsidy, the non-capital subsidies. And actually that makes it more consistent with the cash flow statement categories because cash flow statement you have operating, non-operating, non-capital financing, and investing. All right. Present each, then basically information about component units. So we're almost done here. Present each major component unit separately in the statement of net position. So that actually can be really messy. For those of you who have discretely presented component unit, I know Berkeley, Bob stepped out, but I know Berkeley has a discretely presented component unit. I know Richmond has a discretely presented component unit. If you have multiple component units, you're supposed to present each one of them separate in a separate column, the major ones. And again, major ones, definition of what's major, go back to GASB 14, what's relevant to the financial statements, the relationship to the primary government. But it can get really messy. Your government was already very wide statements and you're going to add a few more columns, then it becomes a problem. So here they're saying if it does not reduce the readability of the statement, even the example they gave in GASB, they assumed that it reduces the readability and they used basically a combining statement approach. So combining statement approach is really saying that if it reduces readability, if it makes it hard to read, then just put one column for all discretely presented component unit. And right after your fund financial statements, you now have to add a combining statement that breaks down those major component units. So if you want to see how it looks like, so this will be a column that shows all component units for the government-wide statement of net position. And then this will be for the statement of activities, this last column. And then right after your fund statements, you will have a combining statement that will show the major component units, the energy authority and airport, and then the non-major component units as one column. So the same way like you do your fund statements, but this will be full accrual basis, same like the government-wide. So that would be the balance sheet. And the income statement will actually still look like the government-wide statement of activities, but it is really broken down into the different major component units and then the non-major component unit. So I can think of, City of Berkeley, City of Richmond. I'm sure there are others that have discretely presented component unit. So really determining what do we want to do? We have 3 of them. Do we want to show one column on the government-wide and then show these additional statements? Or what do we want to do? So again, things to consider. You don't have to do anything this year, by the way. This is still 2026. So we're still 2 years away. So don't panic. All right. Now come to the one fun thing before we wrap. Budgetary comparison information. Presented as RSI for the general fund and each major special revenue fund that has a legally adopted annual budget. So for any of you that used to provide budget information as part of your fund statements, you can no longer do that. So I know some, not many, but some they don't put their budget to actual comparison in the RSI. Instead, they actually put it in right after the fund statements. You can no longer do that. So now it can only be in RSI. Okay, so that's one change. Separate columns for the variances between original and final budget amount. That's new. That's going to be an interesting one because I always scratch my head about seeing a budget that was originally 100 million, then all of a sudden went to 120, but then you look at the actual numbers, it's still 100 million. And like, so why did you go 120 from 100 and then still ended up with 100 million? So this will force organizations to explain why do we have variation between the original budget and final budgets? Because currently you only explain the variance between the final budget and the actual numbers. How did you get from the original to the final budget? Is not discussed. So now it's going to be discussed. And then final budget and actual results and explanation of significant variances between original and final budget amounts and the final budget amounts is now required to be in the RSI. So you can't just have variance column and not explain them. So you're going to need to explain the variances, each one of them. So it's just going to, I think, trigger more thinking about what's really going into these numbers, why they look so different. So just an example of how it would look like. So you'd have really two variance columns. You'd have your original budget, then your final, then a variance column, then an actual, then another variance column. So it's really adding one extra column. I know our admin division here sitting thinking of how many financial statements they're going to have to relink and reformat to basically add these columns. So that's a project by itself. But we have 2 years to get ready. Yeah. And then you will, this is an example of another special revenue fund. And again, maybe smaller so you can see it better, the two columns, the two variance columns. So that's the prescribed format now. And an explanation of why those variances exist. You know, basically just describing what the variances are. And this is actual budget results. And I honestly don't know if it's covering both budget to budget and budget to actual. But in any case, you know, this is a good format to use. You can add more columns, but the idea is that you want to really explain two things. Budget to budget, what are the reasons for the fluctuations? And then budget to actual, what are the reasons for the fluctuations? Okay. Original to final budget, original budget to final budget. So this is just really original. Okay, so if one is budget to actual and then the others are to the budget. Okay. I'm sure there are flexibility in how you want to present this, but the bottom line is this is the information you need to have, is those explanations. All right. And then financial trends, this is really going to be only for business type activity operations. So not your enterprise funds, but if you are a government that is a water district or a sewer district that only have business type activities, your statistical section now, when it comes to revenues, you're going to actually have to provide the revenues by operating, non-operating, non-capital subsidies, unusual and infrequent, basically the categories that we talked about. If you're a city, you don't need to do that because your revenues for the city in the statistical section obviously is different format where you're focused a lot more on your taxes and your other stuff, and then proprietary funds revenues are usually summarized. But if it's just that you're only a business type activity, then your revenues would be more expanded in the statistical section. I'm not gonna get into that, but these are the current projects. You can see that the one that is close by is third quarter 2024. That's a month or two away. That's GASB, gonna be GASB 104, classification of non-financial assets. They're gonna look at capital assets, lease assets, beta assets, making sure that all these non-financial assets are properly classified and consistently classified in the right way. But other things that they're working on, obviously, Revenue and expense recognition, that's probably the most significant. Really, again, looking at the recognition criteria in general. Still, an exposure draft. So I would say that really the first one is the one that we should anticipate probably at sometime soon. And that actually concludes my presentation, not several. I am 15 minutes over, Mitesh, but we do have, I think, enough time. So why don't we take a 5 minutes break? I'm sorry, 10 minutes break, and we'll come back here around 11, and then Mitesh will take us through his presentation.